Welcome back. This is Bottom Line on Bloomberg Television and streaming on your tablet, your phone, and Bloomberg.com. Americans went on a home buying binge in October. The Commerce Department says new home sales rose by 25%. That's the most in 3 decades. Still, revised figures for August and new data from September show the market was weaker than expected. Higher mortgage rates are to blame. Jeff Taylor is co-founder and managing partner of Digital Risk. The company is the 3rd largest processor of mortgages in the U.S. He joins me here in studio. Mr. Taylor, welcome to Bottom Line. Thanks for coming on. How much weight do you give to 1 month's worth of data?
I think we had to take a step back and really realize it was probably 2 months worth of data because we came off such a horrible August, and then with the government shutdown, having September and October come out, what we really saw was a huge reduction in what the anticipation was in September, and then more of a normalized number in October. But that gives you that 24% jump. So
no concerns about the veracity of the numbers given the government shutdown?
Again, I think because of the refinance dropping off by 60% in May, we had the big numbers drop off. But I think October is in a good spot.
You know what? I saw that too. 60%. Why? What happened?
I think for people who could refinance, most of them have refinanced over the last year and a half. And I think when interest rates ticked up a little bit, the people who hadn't said, you know what, I'll take a step back, see if I can get a better rate. And all of a sudden, it was much more than anticipated. But I still expect a healthy refinance market the rest of the year.
Prices for new homes fell in October. They were down 4.5% to $245,800 from September. The prices have declined slightly over the past 12 months. Is this an oversupply issue?
Actually, I think right now we have a little bit of an undersupply issue, because if you look at about 10 million households, people have a negative equity, so they can't really sell right now. Then you have tightening inventories right now. So it's we have a situation right now where we're still looking for some new supply to come in the marketplace, and that's what they're looking to home builders.
Mortgage rates. Latest average on a 30-year fixed loan, 4.29%. Still at historic lows, but it's nearly a full percentage point higher than that number was in the springtime. What's the state of mortgage lending right now? Are buyers still skittish even with rates this low?
You know, I think this is still a once-in-a-lifetime opportunity for the next 30 years. I mean, even at 4.5%, I mean, my God, 30 years, we've never seen anything like this. I think buyers right now, if they're going to buy a house, this is the time to do it. Get into the mortgage, get into a house and mortgage market. The big thing coming up for the next year is all going to be about the cost of compliance. Whether you're a small lender or a large lender, how do I comply with Dodd-Frank, qualified mortgage, the ability to pay? So it's all these rules and regulations they're struggling with to comply.
Speaking of which, there's a lot of pressure to relax lending standards. That's an effort to boost loan volume. We have Fannie and Freddie, for example. They are tightening their credit standards. What's the end result here?
Well, right now we're in a market that's 95% government-driven. So what we're going to actually see is the markets will start to loosen some of the underwriting guidelines. Private capital will start to come back in, and they'll price for the risk, so there'll be higher interest rates, but more credit will be available to more people.
When you say loosen some of the underwriting guidelines, that has its good parts and its bad parts, doesn't it? Because you don't want to get to the point where we were just a few years ago, where, as some people said, if you could walk and chew gum at the same time, you could get a mortgage even if you didn't qualify.
Like you said, and we were so far all the way to the left, but now we're so far to the right.
Sure.
I mean, the average FICO score is 750 these days. People at 700 to 680 can buy houses and afford to pay for the houses that they want. So I think it's just coming back a little bit more to the left will be good for the housing market.
Let's talk about manufacturing defects. There are events that include property valuation errors. They also include income misstatements. How prevalent are these events?
You know, something within our line of business, that's what we're seeing quite a bit right now. While we're at all-time low delinquency rates, the defect rate's about 10%. And so they're right now not causing necessarily buybacks or causing loans to go bad, but these defects over time, it could evolve to be more serious issues.
How do they differ from mortgage fraud?
So mortgage fraud is literally when somebody has no intent to actually live in the house, and they are just coming up with a scheme to basically buy a house, sell it, and for profit. These defects are more like somebody's trying to do a good loan, but the appraisal was wrong. The income was a little bit misstated, etc. So they're defects versus totally lying.
When do we get back to a healthy pace of home sales? The healthy number would be, what, around 700,000? When are we going to get back to that?
You know, I think next year, I think we're going to see a market of around 800 billion to maybe $1 trillion. I think between 2014 and 2015, we could be there.
Is that contingent on jobs. We get that all-important jobs number tomorrow. Is that contingent on people getting back to work?
Well, you know it is, because right now if you're going to buy a house, you have
on
really...
Friday, excuse me, not tomorrow, but yeah.
So, and right now if you're going to buy a house, you have two ways to do it. Either you can put 20% down, and unfortunately right now only about 17% of Americans can afford to put 20% down,
yeah.
or you can use mortgage insurance to go ahead and buy that house up until the point where your loan-to-value is less than 80%. Okay. So I think we're getting there right now.
Jeff Taylor, co-founder, managing partner of Digital Risk, joining us in studio. Pleasure to meet you.
Thank you so much.
Thank you.